Hello, it's Jacob again, and in this video, we'll be talking about inflation. Now, what is inflation? Well, inflation refers very simply to an increase in the general price level, a situation where the prices of most goods and services are going up, with the practical effect of it being that people's cost of living goes up and their practical wage, their real wage, goes down. You make the same amount of money as before, but you can only buy less with it because most things in life have become more expensive. And we don't consider individual goods prices changing to be inflation. There will always be some things that are cheaper. There will always be some things that are more expensive because there's always supply and demand shocks operating on the market. It would be misleading to take any one product and say life has become more expensive or life's become easier just because its price has zigged up or zagged down on a given day. And inflation, it's broad phenomena. It's inherently macroeconomic. It's also the reason why it takes you so long in this semester to get to it. It has no real applicability to microeconomics. And inflation is going to be caused by a money supply increase relative to output. In a moment, we'll see what that means in greater detail. But it is a situation caused by the money issuers, whether that means a mint, a gold mine, a government printing cash, or even, as we'll see, a private bank issuing loans. And when inflation occurs too quickly for a currency to serve its three functions, we call that hyperinflation. Now, before we can talk about that, we need to talk about fractional reserve banking because it's going to play a very important role in determining the money supply. And by extension, it's going to be very important when we get to monetary policy in a few lectures. So, the money supply is defined as being all currency in use, whether in the form of physical money, like cash and coins, or as electronic accounts, like bank accounts. The money supply is not just the literal money in circulation, but it's all the money being spent. And to understand the money supply, you'll thus have to understand fractional reserve banking. You might say, well, how can people be spending more money than there actually is? And this is going to have to do with the nature of banking laws. Now, let's imagine how savings would have worked over 1,000 years ago. Banks have always existed in some form, but most people did not really use them in everyday life until a few hundred years ago. It took a long time for them to kind of diffuse and become normalized. If you have savings, you need to safeguard them. You need a place to put those savings, whether it's in the form of commodities or specie or cash. You have to have some place to stow that away where it's safe from robbers, where it's safe from fires, where it's safe from the elements. And for most of history, people are doing this on their own property. They're responsible for their own safety. And before the concept of a check has been invented, before electronic banking has been invented, the only way that you're going to spend any money is if you physically carry it with you. So what you have is people stuffing cash into mattresses. You have people putting their wealth into a chest and burying it underneath the fireplace. That, in fact, is where all those stories of buried treasure come from. Folks would bury their gold, their jewelry, their silver, whatever valuables they'd have. They'd bury it on their property. But sometimes a property would be abandoned for some reason. Sudden, unpredictable death by Viking, for example. The property would be abandoned, but hidden savings would never be recovered. And then centuries later, you'd have some farmer digging out there. There's no trace of the house left at that point, and he hits a random box. But of course, this isn't an ideal solution. It's maybe not that safe on your own property. Might be a bit of a pain to deal with burying. That'll make it safer, but you know, they can always torture it out of you. And you have people around who keep safes for whatever reason. Their trade involves manufacturing or keeping a safe. And so there's a very understandable, mutually beneficial arrangement that townsfolk come to with them. What if I pay you to hold on to my belongings in your safe? You promise you won't steal it, and you'll just keep it secure. And these are your first banks. And the service that the bank is providing is protection against theft, disaster, all of the vagaries of life. Now, there was another type of financial service people offered, that being debt. I will make you a loan. I'll give you money now if you give me more money in the future. And over time, these two different functions started to merge. You might ask, why do banks now pay you interest to hold on to your money? They don't pay you much, and very often they'll charge a fixed fee for keeping the account open. But at the same time, often they actually give you rewards. They give you money on a credit card if you make your payment before it's due. The banks are hoping that you're going to screw up one day. I know how it works. If the day you screw up, it's going to cost you more than all those rewards ever, you know, benefited you. Well, these two different functions, which might seem at odds or rather just completely unrelated, are directly related. That of the bank making loans and that of the bank safeguarding money. See, the reason banks pay interest, even if it's a very small amount, is because they're taking your money and loaning it back out to the public. They are making profit off of your deposits, and they share just a very small amount of the profits with you. And it used to be a lot higher. A mixture of positive demand shocks. More and more people came to use banking as more and more people started to rely on credit and debit cards. And it also was more heavily regulated by the government, too. Price ceilings in this case. The interest rates did used to be higher. It used to be that you could actually get, say, 8% rates on savings. It's sad. I wish we still lived in those days. But that's what they're doing. You are giving them the right to profit off of your own cash, to play banker with your cash in exchange for the security and convenience of it sitting in their vaults, that it's protected, and that it's also accessible, for purposes of checks and cards. And in order to repay customers who want to withdraw deposits, banks have to keep bank reserves. They have to keep cash on hand. But banks know that everybody won't withdraw at the same time. Not everyone needs a withdrawal at the same time. And so this means that the bank can loan more than they actually have. They would have to in order for this business model to make any sense. And since all of this money is in circulation, you're drawing from your deposits when you write checks, when you swipe your card, and the people they're loaning to are also using that cash. The bank is effectively creating money out of thin air. The same dollar is able to be used multiple times. I've got a numerical example of this. Now, suppose a bank has a policy of keeping only 20% in reserve. Historical experience has taught them that, on average, only about a fifth of their customers need to make withdrawals at any given time, or their customers only intend to carry about 20% of their income on their persons at any given time. Now, their first customer, Adam, deposits $10 with the bank. And then the bank decides to loan out $8, 80% of $10. So they make a loan of $8 to Bobby. And Bobby goes and makes purchases. Those purchases become income for other people. Even if those people aren't receiving 100% of it as profit, they're paying their own suppliers. They're paying the people who sold them, the inputs. So in all, that's $8 circulating around. And the people he bought from put it back in the bank. Now the bank has another $8 to loan out. And so they loan out 80% of that, or $640, loan it to Carla. And Carla, like Bobby, the only reason she would have taken a loan was to buy something. So Carla goes and makes purchases. And that $640 goes back in the bank. Then the bank loans out $5.12 to Deborah. At every step, more money is being spent, even though there was only $10 in actual cash to begin with. More money is because people are able to buy on credit. People buy things on credit. They buy things with money that doesn't exist yet. And then that becomes income, which gets used to buy even more things on credit. And if you were to keep going, you'd find that the money supply eventually approaches $50. Up here, you see that the first customer, they're the one with the actual cash, $10. Second one, well, the second one adds $8. The third one adds $640. The third one adds $512. But you notice that the marginal increase in the money supply keeps going down. And it keeps going down because it's a fraction of a fraction of a fraction. Some of you may have already had exposure to an idea called a geometric series. It's okay if you didn't. If you know what a geometric series is, though, this is going to be a geometric series, a convergent one. You might be curious, how can you keep adding things infinitely, yet wind up with a finite amount? Well, one of the easiest ways to visualize this is to imagine somebody walking across a room. And they every step they take, they cross half of the remaining distance. So in their first stride, a very long stride, they cover half the distance. And then in their next step, they cover half of a half, so a quarter, and then an eighth, and then a 16th. Because they keep taking smaller steps, they can get arbitrarily close to the opposite wall, but they'll never actually reach the opposite wall. And the same thing is true here. Because it's a fraction of a fraction of the initial amount of money, we wind up with a finite amount of money being spent. And of course, in the real world, you don't have infinitely many customers to loan to. In the end, the money supply is going to follow this formula. Money supply equals the monetary base divided by the reserve ratio. So what is the monetary base? That's the cash. That's going to be physical currency. Or if you were talking about something like a cryptocurrency, that would be the actual Bitcoin that's in circulation. And the reserve ratio is going to be the percentage that the bank holds in reserves. Or rather, the banks, right? The banks collectively hold in reserves. And if you prefer, we can also refer to 1 over the reserve ratio as being the money multiplier, because it multiplies the amount of money in circulation. It effectively scales up how much cash is floating around. Now, there are 3 things that limit the ability of banks to create money. One of them is the actual demand for credit. There does have to be someone to loan to. And banking has its own equilibrium. Another is the threat of bank runs. See, in a bank run, the withdrawals exceed the reserves, and so the bank can't pay out. And this causes a panic. Nobody wants to be left without their cash, so everyone tries to withdraw to save their money. But then the bank can't pay back its depositors, and it goes into default. But effectively, the bank goes out of business. And those who didn't withdraw in time are, they're just screwed over. They don't get their money back. Now, one thing to note about these sorts of panics, these bank runs, is that they can happen for no reason at all. Because banks don't keep 100% in reserves, a bank run could happen at any time if the customers wanted to. And so it's essentially a self-fulfilling prophecy. People are afraid the bank's going to run out. So you need to get your money out first. You don't want to be left without it. Everyone rushes on the place. They clear it out. They make the bank run reality. It doesn't always start with the panic. Sometimes if for some reason there is a sudden sharp increase in demand for cash unrelated to the threat of a run, that can cause a run too. These aren't really as much of a problem anymore. Nowadays, we have a thing called the Federal Deposit Insurance Corporation. It was introduced after the Great Depression. Basically, the banks have to set aside some money so that they can they set it aside into a common fund, so if one bank does have a run, the government can still pay off people's accounts up to a certain maximum limit. So nowadays, normal people don't have to worry about losing their savings just because the bank screwed up. Anyways, Government can also set what's called reserve requirements, where they just legally require a minimum percent of reserves. But for the most part, most of the time the government does not do this. For the most part, it's self-regulated. The banks are not going to, if they're competently run, they're not going to loan out more money than they can safely deal with. Because this here is a worst case scenario. It kills the bank. And one last component to the money supply is what's called the velocity of money. So velocity is how many times a dollar can change hands in a given period. So for example, you go and buy a hot dog from a cart, and then the vendor takes that same dollar bill and buys a pack of cigarettes on break from a gas station. And then later that day, the gas station owner uses that bill to pay his clerk. Now that's 3 transactions with the same bill in one day, or a velocity of 3 for that day. And this leads us back to GDP. So you recall that GDP is the total monetary expenditure, usually measured for a month on goods produced in a country. And it was expressed as P times Y, prices times output. Now, if you know linear algebra already, you can think of that as being a dot product. And so you might think of the price vector as having its own magnitude and the output vector having its own magnitude. If you don't know linear algebra, that's okay, because we'll talk in a video or two about how you would actually think of there being a price level, a price of everything. For now, take it as a simplification and abstraction. But it's prices times output. And the amount of money being spent is MV, the money supply, which itself was the monetary base times the money multiplier, times the velocity of money. And in a modern financialized economy, in a modern economy where people keep the vast majority of their money in the banks at any given time, we know that most of that money is going to be loaned back out. And so we could say that it's approximately true that the money supply will equal the expenditures. The money supply will equal GDP. It's not going to perfectly equal it, but again, it will be approximately equal. Or, you might add on a little fraction onto the left-hand side. I've never seen textbooks do that, but you think of like the 20% the bank doesn't loan out, you could stick on a fraction. The important thing here is this notion that there is a direct relationship between the two sides of it, between money and spending. And if you introduce money to an economy, people will spend it. We'll stop here for the moment.